I believe that housing prices are near their bottom or at their bottom now. Now, every housing market's different city by city, but I think prices are near the bottom or at the bottom.
All right, that was KB Home founder Eli Breaux. The search for a housing bottom is the focus of our Wednesday roundtable. Joining us from New Haven, Connecticut is the co-creator of the Case-Schiller Index, chief economist of macro markets, and a professor at Yale University. He is Bob Shiller. And from Horsham, Pennsylvania, we have Toll Brothers chief financial officer Joel Rassman. And right here in our studio here in New York is Alpine Mutual Fund's senior analyst Steve Kim. Steve has consistently been named one of the top analysts for real estate in the nearly 2 decades. He's been covering that industry, and of course our own Kathleen Hayes. And Bob, I want to start with you. You and I talked about the data yesterday, the S&P Case-Schiller Index. Home prices declining, but at a slower pace. Prices, though, still declining. Are we crazy to be even talking about a bottom in the housing market right now?
No, I don't think it's crazy. I think that the way the market has behaved in the past, it slows down for a while and then levels off and maybe tips up. We actually started trading yesterday our securities based UMM and DMM based on home prices on our 10-city index. And so far, the market is predicting flat prices over the next 5 years, basically that they'll stay roughly where they are right now. So the market is predicting that it's over.
Stephen, would you call a bottom here?
I think probably prices are going to fall a little bit more, but then they were not just going to level out. I think they're going to start moving up, certainly if you have a 5-year time frame. However, I would caution that over the last several months, there have been a number of what I would call temporary stimuli that we're going to be weaning off, and I think that could cause another leg down in pricing.
Well, let's talk about pricing. And Joel, what you're seeing, at Toll Brothers, are you seeing any kind of positive signs out there?
I think we have to look at real estate on a micro basis, not a macro basis. Almost all statistics that we talk about are national statistics, average prices of houses, average sales, total inventory. But we have markets that have shown improvements and some markets that are still showing deterioration. And I think the net effect is what Robert Shiller has just discussed, which is a slowing of housing price depreciation. And we have seen some markets in which there, in fact, have been appreciation, at least in the new home side.
One of the most interesting reports I think that was out this week, maybe didn't get, there have been so many numbers, maybe didn't get the attention it should have, was the mortgage metrics report from the Office of the Comptroller of the Currency and the Office of Thrift Supervision. Now, granted, it was first quarter numbers, but one of the things that report showed was that the recession is now the reason we're seeing a lot of defaults and foreclosures. The foreclosure rate, which was over 10%, was driven by about a 22% increase in foreclosures of the prime mortgage holder. Again, a sign that the high unemployment, the recession. So let's maybe throw this out for starters to Bob Shiller. Is that the risk here, that you get this echo effect? Maybe you're starting to bottom, but now you've got this other effect coming in that hits the market again?
Well, I think that, we talk about the recession possibly ending this year, and I concur that that's a possibility. But, there are these things called lagging indicators. Things can happen afterwards. Typically, the unemployment rate is a lagging indicator, and it goes up maybe for a year or two after the recession ends. And so that's the kind of thing that could help produce more foreclosures among prime borrowers.
Pricing is also a lagging indicator as well. That's another thing to remember. Typically, transactions for housing will pick up first. Pricing can lag by as much as a year. I would also mention that foreclosures have been benefiting, the rate of foreclosures has been benefiting actually over the last several months from moratoriums that have been put in place in many states, where basically they said no foreclosures, but the amount of homes entering foreclosure is still increasing.
You've also had mortgage rates low, and I understand on a historical basis they're still low, but they're starting to tick higher, and some people are concerned that that's going to put the brakes. I mean, Joel, talk to me about this. You guys deal in the high-end market. Are you worried about the uptick that we're starting to see in some of those mortgage rates?
Well, obviously our buyer is more capable of buying a house if they want to, so we're more, we believe that consumer confidence is a more important indicator of what will happen to the housing market. Not only in our level, in our buyers, but in almost all buyers. I think we're at a point in which you have indications of the economy improving sometimes and the economy getting worse sometimes, and housing improving sometimes and housing getting worse sometimes, and it bounces around. And we have a tendency at times to look at the world with a cup half full, and other times with the cup half empty. Right now, a lot of people look at the cup half empty.
You know, Joel, we actually had a viewer write in. This was Greg from Atlanta, and, you know, he knew this roundtable was coming up, and he said, his question actually was, are higher-end new homes that cost about $700,000 and up selling? And if so, why? You guys deal in that high-end market. What kind of I mean, you're selling homes that are expensive, and you're seeing that kind of activity, yes?
We are seeing some geographic regions that have stabilized and shown some improvement. But there are other regions like Reno and Las Vegas and Arizona which are still in decline or have not seen stabilization yet. So Connecticut is doing much better, and Reno is not.
Let's look at the other end of the market with you for a second, Stephen, and that is the foreclosure end and the loan modification end. Because this report, the Mortgage Metric report, also showed a very large increase in the number of home retention actions, as they called it.
Sure. One of the problems that we're seeing with the loan modification effort is that it's a rather cumbersome and ineffective process. For example, only 12% of the seriously delinquent mortgages beginning in the first quarter actually were modified, a very small percentage. Of that, only 2% actually saw principal reductions, which is really what people need when they're underwater in their homes, where they owe more than, than the home is worth. And I would also point out that, unfortunately, 50% of those that were modified redefaulted within 6 months.
Right, staggering. Bob, when you hear a number like that, doesn't that say to you, wow, we're going to still see some pretty ugly data here?
In my book, Subprime Solution, last year, I said the really important thing to do now is to institute a new mortgage that pre-plans for workouts. And I call it the continuous workout mortgage. I haven't seen much progress on it, but that's what we have to do. That's the kind of thing that we should be looking toward. New market institutions that risk manage, that deal with this problem that we're seeing that's not being addressed.
Joel, how about a bigger tax credit and more incentives to get people to buy homes? Maybe Toll Brothers doesn't need it so much, but I guess, Bob, what do you think? Would the federal government help everybody out by just getting a little more generous, sweeten up that deal?
Do you want, was that
Go ahead, Joel, sure.
Oh, sure, okay. We saw that the combination of federal tax credit for first-time home buyers and the California tax credit, which was for all buyers, worked very well in California. And I think that a tax credit geared to all buyers would work well to stimulate jobs as well as housing. And I would love to see the government institute some type of program. We've been 3.5 years into a down cycle. Actually 3 years, 9 months into a down cycle in housing, and we've lost a lot of jobs.
All right, sit tight, gentlemen, and Kathleen, we're going to come back, take a break, continue our discussion on housing. All right, welcome back. We're talking housing. Bob Shiller, chief economist at Macro Markets, Toll Brothers CFO Joel Rassman, and here in studios, Alpine Mutual Funds senior analyst Steve Kim, and of course we're here with our Kathleen Hayes. ARM resets, got to talk about that. Joel, is that something that worries you? I mean, when these roll over and go up to higher rates, people are worried about, major defaults and so on. Is that something that could impact you guys?
I think anything that destroys consumer confidence will impact all of the home building business. And if the ARM resets will hurt consumer confidence, I believe that will hurt all of us.
Bob, what about your take on these resets?
Well, I think resets are a factor, but, I think studies have shown that they're not the major factor. It's a lot of individual defaults are determined by the general economic conditions facing a family, and that's only part of it.
Well, and you talk about the general economic condition, Kathleen. I mean, we talk about less bad being good, but there's still a lot of bad out there.
Well, again, I think in the housing market, you had the subprime borrowers who got hit by the balloon payments, and so they started defaulting. But again, this report, to come back to it, showed that prime borrowers are having a hard time. Stephen just talked about how bad the mods are, and there are not that many loan mods being done, loan modifications. But apparently, prime borrowers can't get them because their incomes have dropped too much and they've incurred too much debt. So first the subprime defaults,
right. Now
we've got the recession impact.
We talked about government help and government assistance. We actually got some news from Fannie Mae today, but
Sure.
Is this really going to make a difference, Stephen?
I really don't think so. For example, there was an announcement that they were going to be extending the amount of aid that they were going to be giving. They were now going to be taking people who are underwater in their home by 25% instead of just 5% and saying, okay, now you can participate in this loan modification program. The problem is that we just talked about the fact that the loan modification program is not working. And so therefore, this kind of thing of trying to use a sort of broken mechanism is really not going to help the situation.
Bob, you know, you watch the trends. You've got you know, your housing index, your price index. I mean, what are you going to be watching for very closely in the next 3 to 6 months to confirm to you that things are, you know, we're really kind of turning the corner? I mean, the price is still down,
right?
But what are you going to keep a close watch on?
I'm concerned about confidence. You know, I wrote a book called Animal Spirits, and I think that animal spirits or confidence, general trust in our market system and each other, these things fluctuate, especially at a time like this. We have a kind of Obama effect, kind of a euphoria because we have a new plan and a new president. I'm just worried that confidence might not hold. It's improved. We've seen a little bit of decline already. I want to see the confidence numbers continue to be strong for a few more months. Then I'll feel better.
Joel, those folks coming into your showrooms, taking a look at models, how confident do you think they are, really?
We saw an improvement in confidence in our sales offices about 3.5 months ago when we asked our sales managers to evaluate the quality of the traffic that we saw. And although it does deviate from week to week, I think there's been a higher confidence level over the last few months than there had been previously. And I agree with Bob, that I think confidence is the key factor.
Stephen, got to talk though also about the stocks. Investors were pretty confident in those home building stocks earlier this year. We saw a nice bounce. They've come back. What's your take, you know, on the home building names?
I think that the weaning off of some of the stimuli that I was referring to, the California stimulus, the national stimulus, which is no longer going to be in effect if your home closes after November, the foreclosures coming in, all those sorts of things are going to weigh on the stocks. However, I do believe, as I started off the whole segment with, that home prices are going to recover. And if you've got a longer-term horizon, which at Alpine we do, you should actually be using this period of time, I believe, over the next 3 to 6 months to be building positions at attractive levels.
Any names you like? We just have a few seconds left.
NVR in particular is a name that I've liked for a while, and I continue to like it. I think it's one of the most conservatively run builders. I would also say, for those who are willing to play a little bit more on the ragged edge, Lennar.
All right. We're going to have to leave it on that note. We could talk for a long time on housing because there's still so much going on. I do have to say goodbye. Bob Shiller, we appreciate your time today. Joel Rassman as well, and Stephen Kim right here in studio with our own Kathleen Hayes. Thank you to everyone.